Hi, it's Dre Griggs, the Obsidian Wisdom. Today we discuss advanced dividend investing strategies. Today we're going to continue our dividend series. We have 5 new questions that we'll answer today. These questions include: how can I diversify my dividend portfolio? What tools or resources are available to analyze dividend stocks? What is the impact of inflation on dividend income? Are dividend stocks better than growth stocks? And what are the unseen benefits of dividend investing? When you're answering question number one, how I can diversify my dividend stocks, it's important to recognize that when we diversify, what we're basically saying is, I'm not 100% sure what the future holds. So I want to diversify in a way that allows me to make money in a variety of economic climates. And I accept the fact that I may lose some money in a variety of economic climates, or at least I won't maximize my potential outcome. That if we were able to pick the 10 best stocks, that would outperform a diversified portfolio that had 5 of the best and then 5 of the worst. But at the same time, we recognize that it's better than having 10 of the worst because we don't know what the 10 of the best are. Unless we work for Congress, then they don't have to diversify because they have the oversight and they're able to choose the stocks that are always winners. When it comes to our government making a ton of money from the industries that they have oversight over, which I know doesn't sound like it should be legal, but currently it is, there's even websites that will follow them so you can just match their funds. Because the assumption and the thing that I think we often overlook and when it comes to investing is that you actually do have the ability to choose winners if we had enough information. Now, do we have all of the information that Congress has? No, of course not. That's why they're crushing it. And you and I, it's not as guaranteed. But because it's not guaranteed for us, that's why we normally will decide it makes the most sense for us to diversify our portfolio, that we don't have the same amount of information that Congress has, where they're able to change their investments because they knew that COVID was coming because they could see the information that you and I were not given. So when it comes to diversifying your dividend stocks, I'll give you 3 tips that you can use. The first one is we can diversify by adding international stocks. Now, when you're adding international stocks, we know that that opens us up to some risk because we don't know what's going on in these other countries. We barely know what's going on in our own country from a day-to-day basis. But when we do open ourselves up to international stocks, it's just the idea that I know that there are great businesses outside of the United States. And if you are looking for advanced dividend strategies, opening yourself up to the international market is a great place to start. Of course, that doesn't mean we should just choose any international stock. The reality is when you're opening yourself up to the risk of international stocks, for the most part, we actually want to be more restrictive in our search. The increased risk international stocks give us of not having all of the information that's available. There are some countries that we do have more information than others. And I normally allow that to be one of my main deciding factors when I'm choosing a company. I do care about things like market cap, which is a very fancy way of saying how large is the company. I don't want to be investing in penny stocks. So for the most part, we're normally going to be looking, depending on how close you are to retirement, I would say probably at least $100 million when you start looking at these companies. But depending on your comfort level, I would definitely even consider not going below $1 billion. That when I look up this company, that it should have $1 billion in market cap, at least for me to consider it. Now, of course, this can vary, but I would tell you for the most part, going below $100 million is basically gambling, that there's just not enough information. Now, with that also being said, that's why we have to look at companies in countries that do have similar court systems as ours. There are countries where if a company lies on its financials and you and I are looking through and we found a really good company based off the information we are given, that we don't have any ability to sue that company, that no one is able to do anything, that the analysts could be lied to, that you and I could be lied to. And unfortunately, bad information in, bad information out. So that tends to limit you to choosing other industrialized countries or at least very advanced developing countries, that we're not going to be taking the risk that is often seen with choosing a country that has a high level of corruption, where there is no recourse for us, that the information isn't available for us to make informed, sound decisions. Now, if international stocks seem like too much work, then normally diversifying by industry sector is another great opportunity, and you can still stick with US companies. So with US companies, we know that there's a variety of economic climates, and we've talked about the idea of being able to outperform in a recession versus being outperform in times of economic growth. And that if you wanted a consumer staple, which is literally what it's called, that is an industry where you and I have to buy a certain amount of things no matter what's going on. And that could be toothpaste, toilet paper, some groceries, water. electricity, we got to pay our electric bill, and we got to put gas in our car, energy, that there are certain sectors that you and I understand we have to continue paying for. And the way that we normally talk about it from an economic principle is it's something that's inelastic. Inelastic is a very fancy way of saying it's very hard to replace it from my life. That you and I have a difficulty finding other things than gas to put in our vehicle. That sure, we could carpool, sure, we could take public transportation, but someone has to put gas in their tank. Or if I'm in healthcare, I know that I may have to take certain medicine every single month or every single year or whatever the frequency is, and that there's not much I can do. That if they double the price of my medicine, but that medicine keeps me alive, then I have to buy it. Even if I started cutting my pills in half or I took half of the prescription to try to make it last, I still have to buy it. And so we find that something that's inelastic, hard to replace, that's normally a great place for us to invest when we're talking about diversifying. Now, on the opposite end is something that's elastic. When something is elastic, that means it's something that's easily replaceable. That's normally going to be fun things like buying jewelry or taking trips, that there are certain leisurely activities that we can replace. On a very simple level, if I went to the grocery store and I was someone who loved honey, but when I went there, the price of honey increased by like 300%. Would we still buy the honey? Probably not. Even though I don't like syrup, I would probably buy syrup. That's a reasonable substitute. That there's no reason for me to spend 300% on something that I could just get it for a third of the price and it's going to taste kind of the same. And that's generally the idea of something that doesn't perform well when we're talking about a recession. Something that I can cut back on, or I can replace it altogether with something that's much more affordable in my budget. When we're looking at this, these are the way that we look at the sectors and we say, okay, these are sectors that are need to haves, want to haves. These are ones that I think will perform well during times of economic growth or during times of inflation. These are industries that I think will perform better during times of deflation or stagflation. And we then build this overall portfolio based on these overall industries. We've accepted the fact that since I've already diversified by industries, that I know some are going to perform better than others in a variety of economic climates. That's okay because I'm expecting to have an average return that achieves all of my financial goals that I have set for my own personal retirement plan. The third way that we can normally diversify, and we've discussed this in another video, and I'll put a link to it for you, is we can diversify by dividend yield, which is the dividend divided by the stock price. Whatever the dividend yield is, I know that generally speaking, a dividend yield of 4% is considered relatively good. I know that the stock market on average, the dividend yield is about 2 to 2.5%. And from there, we know that there could be a variety of dividend yields, but that's just one metric. And we'll talk in the second question where I'll go into more detail about choosing exactly how to find a dividend stock. Now, many of you are going to say, Dre, that's really not that big of a deal for me. I'm going to choose an ETF or mutual fund, which is equally fine. The thing about a dividend yield is it's normally going to be an immediate benefit. That whatever the yield is, I know that that's the amount of income that I'm going to receive from that particular stock. If you're looking for long term where the retirement isn't in the near future, then I might be looking at dividend growth stocks. And when we're looking at dividend growth stocks, all we're basically saying is I'm not as focused on the immediate income. I want to choose dividend paying companies that are also appreciating. So they might not be paying as high of a yield. The yield might only be 1%, but it's growing by 10%. This is still a growth company. And we went into a lot of details in a separate video where we discussed that, and I'll put a link to it for you. But what we're really saying is you have two choices. You could be focused on the immediate, and that's going to be some of the income, or you can be focused on the long term, and that's going to be some of the growth and appreciation of that company and stock. But what we normally would do is we would blend them together. And if you blend them together, you diversify based off of dividend yield and dividend growth, and that normally gives you a little bit of short term and a little bit of long term in a way that blends very well to manage the risk of choosing dividend stocks. That leads us nicely into question number 2, which is what tools or resources are available to analyze dividend stocks. So if you are someone who is saying, I'm interested in learning more about stocks, how to choose them, how to recognize good opportunities, there are a variety of apps and applications that you can use, some that you pay for, some that are free. 4 tools or resources that you've probably heard of are Seeking Alpha, which offers detailed dividend analysis, including payout ratios, historical performance, and forecasts. You've probably heard of Morningstar, which provides financial health ratings and dividend sustainability scores, the likelihood of that dividend being paid out for 10, 20, 30 years into the future. Another dividend resource is dividend.com. They track dividend histories and they let you know of any upcoming ex-dividend dates, which is important when you're talking about being taxed at capital gains versus being taxed as normal income. And the last two tools available are macrotrend.net and yahoofinance.com. And I'll use those today to give you just a quick example of what you can do for someone that's not interested in paying for these services, where they don't want to pay for this information. It is fair to say that if you do have a paid version, that it gives you more information, more features, and it just helps you make a better, more informed decision. That ultimately, when it comes to choosing stocks, you have to have a level of curiosity that allows you to be able to recognize the gems and to be able to avoid the landmines. So what we'll do, and I'll share my screen with you, you'll see that we can go to macrotrends.net, and then they are a free resource available for you to be able to understand and explore and research stocks. So I would go to Stock Screener, because at this particular time, all we're looking for is how do I find some dividend companies and make sure that I'm making a good decision. So you can see that we currently start off with 5,529 stocks matching. And all we're saying is these are all the stocks that are being pulled. A lot of this information matches Yahoo Finance, and then it is a free resource again, so we can go through it. Normally what we'll do is we'll say, all right, well, I want to make sure I'm choosing a dividend paying company. So I would start with my dividend yield. And you look at your dividend yield, it tells you, just as we said, it's your dividend yield divided by your price per share. We're going to change this to 4% because we already discussed that 4% is good. That 2% is average, 4% is good. Obviously anything above that would be even better. So we're just going to change the minimum to 4%. And you see that that now lowered us to only 560. So we literally got rid of 90% of the stocks available, but a 560 stock portfolio was still going to be too many stocks for us. So what else could we look for? Normally we would say, all right, well, the next thing that I want to look at is my market cap. Dre told me not to be trading in penny stocks. So what would be a good market cap for us? I said at a minimum, you'd probably want to look at 100 million, but that I would probably strongly consider a billion, just depending on how close you are to retirement and how comfortable you are with the risk, because 100 million is definitely going to have more risk than 1 billion. So what we could do is we could choose 100 million and see what that does. That drops us to 518, and that doesn't really change us too much. We changed to 1 billion, that dropped us to 324. So I do believe that's probably going to be the way we should leave it. The next thing we would look at is, let's look at the fundamentals. So we talk about the fundamentals of the company. It gives you a wide range of ratios, but some of the things that we'll look at is, of course, it normally makes sense to look at my earnings per share. So this is my 5-year average. I generally want to make sure that we at least made something. I don't want any losses over the last 5 years. And that, of course, is including COVID. So we do take it with a little bit of a grain of salt. We're really just trying to get this list small enough, probably somewhere between 20 to 40 stocks. From there, I can start reading and researching about these different companies to see if they make sense to be inside of my retirement plan. So then my earnings per share, I want to make sure I haven't lost any money over the last 5 years. I normally like looking at the PEG ratio, and all we're doing is we're taking the price per earnings, but we're adding a measure for growth. I want to make sure it's also a growing company. And normally being at 1 is going to be considered a good PEG ratio. So we're going to go ahead and change this to 1. You see it dropped us down to 71. And then from there, we normally want to take a look at what our net margin is. And all we know from our net margin is just how stable this company is. That for the most part, if you're an order maker, then you probably have a margin that's higher. Think of Apple. Apple is someone that we know is a higher price than your average computer. And that's because Apple is a order maker, that they have a brand, a moat, a very respectable company that people will stand in line for, that people will watch them give product announcements, that people love this company. And if you're not someone who just follows every company, that we know if you normally have a good margin, that generally lets us know that you are a very stable and successful company, generally speaking. And so we'll say, let's make sure we have at least a net margin of 10%. And that dropped us down to 40 stocks. So from there, we can say, all right, 40 is going to be okay. Dre said like 20 to 40. You may have 50. You may only want 15. You can continue going and looking at these different ratios. I would then change to the dividend tab, and then we're going to take a look at what our number is showing us. So you see at the dividend tab, you see our payout ratios, as we mentioned. We normally don't want a payout ratio above 75%. And we can see that there are 2 companies that are slightly above that on the first 20, but it's okay, right? We definitely are like, all right, these are companies I'm all very familiar with. This is part of the reason that we chose $1 billion. So I feel relatively okay as far as just starting my search. I see my dividend yields are all above 4%, as we mentioned, and then it tells us what that dividend is per year. and what their earnings per share is. And naturally, when you divide that, that then gives you the payout ratio. So what percentage of the earnings are we paying out in dividends? That's what your payout ratio is. We move to the second page and we can see that there's several companies that are above that 75%. And so for you, it depends on how much risk you want to have, whether you want to take a look at these different companies and see if there's just something that explains why this dividend payout ratio is so high. But you can see that the highest one here is a UMH property. So it's a realty company. You can also see Realty Income, another dividend paying company. So you can see that the highest payout ratios are all realty companies. Based off of that, I might say, okay, well, I'm noticing that Agree, Kimco, Sabre, Realty, and UMH properties, these are all in the real estate industry. So maybe that's not an abnormal dividend payout ratio, but I would need to take a look. I know that high level, a REIT, a real estate investment trust, that for them to receive the tax benefits that they're designed to receive, that they have to pay out 80% of their profits in the form of a dividend. So that could explain why, but I would need to explore this a little bit more. You can also see on the upper end that we have an extra space storage, and you also can see that we have a CubeSmart storage. I'm starting to notice a trend. I've already seen that there's a lot of REITs that have a high dividend payout ratio, and now I'm seeing a couple storage companies with a high dividend payout ratio. And so while it's outside of the scope of this video to go into detail and look at every single company, we will at least look at the largest dividend payout ratio, which was UMH Properties. So I would go to Yahoo Finance. I could type it in. It's a free resource that's available. I'm normally going to look at the last 5 years because I'm deciding for me whether I'm interested in investing for the next 5 years. And so that normally means that looking at it for 1 year or a year to date or a few months, that doesn't give me enough information. And so you can see that over the last 5 years, I had an 11% return. I can see that there was a little bit of volatility. How do I know that? Well, I would come down here and I would look at my 52-week range and I can see that I had a low of $14 and a high of $20. And while that $6 change might not seem like a lot, we're really talking about upwards of 30% as far as the change. And then I can say, all right, well, we're at a high of $20.64. It's currently at $18.12. So that lets me know that we're relatively closer to the high than we are from the low. And then we can go from there as far as reading about the companies. You can click on things like the news and just see what they're in the news for, if it's good or if it's bad. Are they getting contracts? What are they buying? Things like that, where you can read about some of these different companies. Now, of course, this is just a free version, so they wouldn't give you all of the information, but they would give you a lot of the information, enough for you to be able to make an informed decision of whether it makes sense for you in your portfolio. We're not trying to find the home run, so we're definitely playing this more safe than sorry. And so if you see anything that makes you uncomfortable, there's just so many companies out there to invest in that there's not a large reason for you to take that amount of risk when we're talking about your retirement funds. Now, if you're someone who has your retirement set and you have a long-term perspective of building generational wealth, well, then sure, we can definitely get into the nitty-gritty and make sure that we're choosing something that has a little bit more risk because we have a longer time horizon, which is a fancy way of saying that we have a longer amount of time before we need or will touch the money. Question number 3 in our advanced dividend investing tips is, what is the impact of inflation on dividend income? So the answer really depends on what dividends are in your portfolio. If you have an all dividend portfolio, then inflation is going to make dividends look less appealing. So for example, if your dividend yield is 4%, but inflation is 5%, then your dividend is less appealing, where I'm being paid out at a 4% rate, but inflation is at 5%. So that means that my purchasing power is actually decreasing, that I'm not able to afford the same lifestyle that I used to be able to afford when this whole thing started. Now, the reason that depends is because if this is a conservative part of your portfolio, then you're okay because you're like, basically, my most conservative part is keeping up, relatively speaking, with inflation. That is better than a savings account. That's better than a money market account, that I'm getting a higher return. So as a result, I'm okay with that. So it's not going to change my overall portfolio. But if this is the majority of your portfolio and you're finding out that you're not keeping up with inflation as a whole, then you'd feel very uncomfortable. For a lot of people, what we end up doing is when we're looking at dividend paying stocks, we want to find stocks that are increasing their dividends every single year. Because if I start out by finding a dividend yield of 4%, but every single year they're increasing their payout ratio, now that distance with inflation and how much I'm receiving, I'm actually growing the same way. And so companies like Procter & Gamble, that's why people are excited to invest in them. Because not only are they paying a dividend, not only are they a dividend king where they've been paying it for decades, this is a company that is also increasing its dividend every single year as well. As a result, I'm able to hedge a lot of that risk that I have when it comes to inflation. But if you just have a dividend paying stock and it's not increasing, that they're paying the same dollar amount, because what I can buy for $5 today is not as much as what I could buy with $5 in 10, 15 years, which most of us will be retired for that long at a minimum. So then when you're saying, all right, well, I remember when gas used to be $1 a gallon and my parents would drive around and I would see it. I'm like 99 cents, a dollar one. And when it was $1.05, it was kind of crazy. But you and I know that gas now is 300% higher than that, that it is much, much more expensive than $1 a gallon. That then means if you were not increasing your dividend income, your income is basically built on a lifestyle that has gas at $1. And that means that at the new price of $3, $4, $5 a gallon, you can't afford as much gas, if any, really at all. But that's also why, as we mentioned, if the dividend is part of your conservative portion of your portfolio, well, your dividend investing is generally going to do better than fixed income. So someone who had $10,000 invested in a dividend stock yielding 3% and growing dividends at 5% annually will outpace inflation compared to a 3% fixed bond. Question number 4, are dividend stocks better than growth stocks? And you probably know what I'm going to say because I generally kind of give that same thought, and that is, it depends. It depends on what you're looking for from your investments. Each of us are very unique. It's not a cookie cutter, one size fits all approach. If you're someone who wants safe and relatively stable companies, they're probably going to be here for the life of your retirement. There's a small to 0% chance that those companies will go away. They're not growing as much, but they do have a pretty steady and consistent dividend. Then you would invest in companies like Coca-Cola. Coca-Cola is not going anywhere. And if they do, then we're all in a huge heap of trouble because Coca-Cola is a conglomerate and it has dozens of companies that they own inside of their overall investments in a variety of different industries. And because of that, they have a much lower volatility where that stock is not going to be changing significantly. On the other hand, stocks like Tesla, while we do have the opportunity for lots of capital appreciation and growth, it doesn't change the fact that that is a pretty volatile stock. In fact, if you look up and people who love option trading and they make it seem like it's the easiest thing in the world, one of the ones that they love trading is Tesla, because Tesla is very volatile. It does move a lot in any given day. And that means that for a long-term perspective, that might be something where I may be able to have some of it because I want the growth, but I probably shouldn't have an entire portfolio dedicated to Tesla. But I probably shouldn't have an entire portfolio dedicated to Coca-Cola either, because I want to be able to grow my overall portfolio. So for a lot of people, it depends on how soon you need the money, how soon you're going to retire. That if you're someone who's getting closer to retirement, where we're starting this shift from capital growth and accumulation to capital preservation, that we're going to be choosing companies that are safe and keeping up with inflation, that are still growing so that way our money is not losing its purchasing power, but there's a very limited chance of me losing all the money that I worked for. The idea is that we get rich once and then we only have to get rich once. Versus if I have 20 years or so, then I could be focused on growth. It doesn't make sense for me to be slowing down like I'm at the finish line when I know that there's a lot of years and a lot of opportunity available. And the main reason is, and you can see where the stock market as a whole is generally going up over time. The problem is it doesn't actually go up every single year, every single second, every single stock. The reality is there are companies that disappear, that are gone forever. That yes, the stock market does go up, but there are companies that file for bankruptcy that are gone. That we do have recessions, that we do have significant loss in the stock market. In that, yes, over the long term, it kind of blends itself away. But in the short term, especially if you're very near retirement, that short term could make or break whether or not you run out of money in retirement. So if you're someone who's within 5 years of retirement, we're going to lean more on the safe companies like Coca-Cola. If you're someone who has 10 or more years to retirement, then we're probably going to lean more on those growth companies like Tesla. But at the same time, we're normally going to have a blend of both of them, that there's rarely any reason for us to be all in on growth and risk and gambling, in the sense that we don't know what these companies are going to do in the future. We believe they're prepared for the future, but we don't know that they're prepared for the future. We're forecasting that these companies are going to be amazing in the future, but we don't know how the future is going to go and the things are going to change. We're in very volatile times right now. And what I mean by volatility is a lot of companies make decisions based off of how well and how comfortable they are with the future. And as we've made this shift in 2025 with the new presidency, a lot of people are waiting to see. I think you just saw the jobs report. There was fewer jobs that were added this month. And then obviously that's a trending, but for the most part, as a company, you're trying to see well, what are we going to do? Where are the laws going to change? What do I need to do? Where are these tariffs going to be added? Where are these regulations going to be taken away? Where there's a little bit of good, there's a little bit of bad. So I don't know if I should hire people. I don't know if I should invest in that one project. And so a lot of times people wait and see. And so you're going to find a lot more volatility in 2025 as companies make adjustments of what they believe the future looks like. And the stock market as a whole is all of the companies together. So the stock market as a whole is going to have that wait and see approach, making adjustments and relatively higher volatility because they're not sure what the future looks like either. Our fifth and final question is, what are unseen benefits of dividend investing? And so we're going to do two of them. There's lots of unseen benefits, but for me, someone who focuses a lot on the behavioral aspect of investing, I'm someone who feels that if you're able to see yourself receiving an income from your investments, that it increases the likelihood. It gives you that good, warm feeling where you're like, oh, look at that. I put in $5 and they gave me back 50 cents. I put in $500 and they gave me back $10. Where I'm sitting here looking and I'm like, this is kind of cool that I'm building an additional stream of income. Then dividend investing is a long-term approach in the sense that if you do want a significant amount of income in your retirement coming from your dividends, you normally have to start that and have at least a 10-year strategy because it does take a good amount of money. And we talked about the dividend yield, but we know that the rule of 1,000 says that for every $1,000 that I want a month in my retirement income, that I normally have to have somewhere around $250,000, $275,000 in my portfolio. And so if you have a dividend yield of 4 or 5%, then that means that I would need somewhere around that 250 to 275,000. Now, it doesn't mean that if I didn't find a 10% dividend yield that I would still need that 250 to $275,000, because the reality is you wouldn't. If you wanted that same $1,000 a month, then you would only need $120,000 because, again, the 10% yield, $120,000 divided by 10, that gives you $12,000, which is $1,000 a month. So we would sit there and say, all right, if I'm receiving this income and I'm investing my money, I'm getting the short-term immediate satisfaction of being rewarded where I'm immediately seeing the benefit of this. I then am able to do this long term. I'm more likely to be committed over the long term to build my portfolio to the amount of money that I need to actually start replacing my income. Where you might get to a place where you can see that if I wanted to, I could pay my mortgage from my dividend income, which feels really good. Because for most people, if you didn't have to pay your mortgage from your active income, how would that change your life? And for a lot of people, something as small as $1,000, $2,000 a month, you can pay your mortgage and then you can take that money and pay off debt, or you can invest in a rental property, or you can reinvest in the stock market, where it just opens it up for us. It changes the game. And that's why you guys always hear me saying that the goal is to have 3 streams of income, because 65% of self-made millionaires have at least 3 streams of income. And so I'm someone who says, if I'm able to build additional streams from my money working, then I'm someone that's going to be able to grow my money much more quickly, which, as I've been teasing, the second benefit is the financial benefit. So dividends, you're allowed to have a DRIP, which is a dividend reinvestment strategy. And all we're saying is if I don't need the income, I'm going to let my income buy more stocks, which is great. So now you have your active money buying stocks and you have your passive money buying stocks. So your dividend, generally speaking, will grow at a higher rate than someone who only has active money, but they don't have any passive money that's buying stocks as well. And because most of these funds are interested in you leaving your money in there, they make it effortless for you, where you can just simply click a button and say, I want to reinvest my dividends, and then that's automatically done for you. And then Uncle Sam is very excited by you leaving your money invested for over a year and a day, and gives you much more favorable tax treatment, where it again opens up the options available to you to be able to grow your funds as well. It's why in the 2008 Great Recession that people kept buying McDonald's stocks, because McDonald's was paying its dividends through the recession. So when the majority of people were starting to leave the market because they were losing money, they were very uncomfortable, they didn't know what was going to happen, McDonald's was still paying out dividends. And I do believe a part of the reason that it did grow so much is because people were like, well, if there's a whole bunch of companies going under, if anyone's paying a dividend, that must mean that they're in a pretty good situation. It's kind of the same idea when we had that TARP bailout, where they said, okay, if you did not accept the TARP bailout, you must be in a pretty good situation. That is just something that builds another level of comfort in a time of volatility and uncertainty. And so when you look at that from even an emotional, behavioral perspective, or even from a financial dollar and cents perspective, Dividends give us this unseen benefit of being able to be disciplined in maintaining our overall investment approach and strategy. So as you can see, advanced dividend investing isn't just about high yields. It's about building resilient, diversified portfolios that align with long-term goals. By leveraging tools, understanding inflation's impact, and balancing growth with income, you can navigate the complexities of dividend investing and achieve financial success. As always, I'm Dre Griggs. I'm thankful for our time together. If you found value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insights on how to build your own wealthy retirement system. Until next time, stay safe and enjoy life.